Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today I am joined once again by Rick Rule, a highly experienced investor and speculator from Rule Investment Media. So, Rick, welcome back to the show.
Always a pleasure to be with you. Thank you for having me back.
Yeah, same here, Rick. Really looking forward to chatting with you today, especially now that you're back from your vacay. And the goal of this conversation is essentially to help investors by providing them with mental models, concepts, and frameworks to help them make better decisions. So, Rick, the first mental model that I want to talk about today with you, Rick, is anti-fragility. So what does this word mean to you? And how has your experience in natural resource investing informed your understanding of anti-fragility? And what examples can you give investments that have benefited from volatility and uncertainty?
Well, I think in the beginning, to answer that question, investors who propose to make themselves anti-fragile, which we'll define in a minute, need to read the book. Nassim Taleb, I think, did a wonderful job of codifying the whole concept of anti-fragile in the book. So any of your listeners who are interested in this discussion need to understand that we will today cover 0.5% of what's in the book. And now we'll get to it, but invest in yourself. Understand that you need to invest in yourself. The book's premise is that great big human systems are by nature fragile. As we've seen very recently, the banking system, taken to its illogical conclusion, is fragile. The stock market, because of the competing forces in the stock market, governments, the broker-dealers, the issuers, is fragile. World peace, as we've seen in the Ukraine, and as we're seeing now around Taiwan, is fragile. And the book, Anti-Fragile, talks about the fact that you need yourself to approach the world from your own framework. You need to be durable, you need to be intelligent, and you need to be less influenced by the mistakes of others than you need to be influenced by your own goals and by your own ability to deal with exogenous shocks. Many, many times in my life as an investor, but more importantly, as an educator, I've heard complaints from people about the fact that they couldn't accomplish their financial goals because of external shocks, pardon me. They couldn't do it because of high levels of taxation. They couldn't do it because of government regulation. They couldn't do it because their fear that Trump or Biden or some other clown was going to have such deleterious impacts on the economy that there was no sense in trying. That mindset makes you more fragile than you need to be. You are already challenged by overregulation. You are already challenged by woke sociology. You are already challenged by the political class. And the idea that you surrender yourself to those external forces, that you make other people's problems your own, you become fragile. Anti-fragile says that to a greater extent than not, you control your future. Your future isn't controlled by others. Your job is to adapt your response to the circumstance rather than be frozen by the circumstance itself. Your job is to turn a crisis into an opportunity. Ben, what's a bear market? I'll tell you what it is if you're anti-fragile. It's a sale. In a bear market, assets got marked down 50 or 60%. That means that the assets that you already have are at least temporarily cheaper if they're anti-fragile assets, if they're assets that can endure. But more importantly, particularly for a young person like yourself, you have the ability to acquire legacy assets at a 50 or 60% discount. Anti-fragile means that you look at the stock market the same way that you would look at a market for physical goods. If you were in the market yourself, Ben, or your listeners were, for a winter coat, and you went to a shopping mall, and you had done a little bit of research, and you determined that for a high quality winter coat that could last you a decade, you'd have to be prepared to pay $400 or $500. and you saw a suitable coat on sale for 50% off at $200, you'd be elated. But if you owned a stock that you thought was worth $400 and it got marked down to $200, you'd be angry. Anti-fragile is the process of understanding that a bear market, while inconvenient, is a sale.
I love that, Rick. I'm really happy that you brought up that example, with reframing the concept of almost like an opportunity, right? Like if there's a sale, why would we not be more interested if it's something that we think is valuable, right? So I'm really happy how you went into all the anti-fragile and kind of what that means. And and I really appreciate that response. But something that I want to move to, I know there are other really big concepts that go a little deeper, and another mental model that I want to touch on is a barbell strategy. And I think this is really important for investors because we have different types of investors. We have investors and we have speculators, and both things are very different. And I know that you do both, Rick. So the question that I have for you is, what is a barbell strategy? And can you describe a time when your barbell strategy resulted in outsized returns in the natural resource sector, and what specific factors contributed to that success?
Although it's in the book, I'm not so sure that I could relate barbell to anti-fragile. I think the barbell concept is useful for natural resource investors and speculators. The barbell suggests, as the image suggests, that one's portfolio contain both value beta-oriented investments, where your returns are correlated to the outperformance of the natural resource sector relative to other savings and investment asset classes. By nature, a more conservative orientation. The other side of the barbell, of course, is more speculative assets, where you're looking to generate alpha, where alpha is defined as the outperformance of the assets that you have chosen relative to other assets of that same class. So as an example, a natural resource investing barbell strategy might consist of having whatever you considered to be the appropriate allocation to investments, say ExxonMobil, BHP, Rio Tinto, the biggest and best, finest natural resource companies in the world, the companies that will benefit almost without a doubt from increasing demographic demand for natural resources, irrespective of most other inputs. And by the way, with much lower risk of internal fear from bad decisions by the company's management. The other side of the barbell would, of course, be the junior resource companies, the exploration companies, where you were taking improbable risks in search of very high reward. Speculators need to know, because positive speculators are focused on the upside, that the probability in each individual speculative decision is failure, which is to say, it's commonplace if you allocate money to 20 speculations that you will lose money on 12 or 13. You don't do it to lose money. You do it because of the simple math of exploration and speculation. If you have one 10-bagger or one 20-bagger, that amortizes an awful lot of 15 or 20% losses. But for the barbell strategy to work, for the speculative strategy to work, you need to understand that losing money on some of the speculations is part of the process of excessive gains on the other. So the barbell strategy is simply the strategy where one balances the search for speculative upside and the probability of numerous failures in the search for that upside with the search for investment style returns, probabilistic returns that are by nature less extreme than the individual returns that somebody might enjoy in one of the stocks in their speculative portfolio. Go ahead, I'm sorry.
I was going to say, no, I love that because I think it is important, for people to think, that the high risk, obviously it will give us, better rewards. But at the same time, we can't put our eggs in one basket. And we see that especially with a lot of millennials or kind of younger, traders who are more speculative. they often do that, right? They really put a lot of high risk, and they got to be careful. And that's kind of why I wanted to bring up that strategy.
I think it's very very important to qualify what you just said. There are certain mental models, as you would describe them, character traits that make one a successful speculator. They are, at least with regards to natural resources, a contrarian bent. If you speculate in the same place that everybody else is speculating, you will overpay for your speculations. That's a guarantee. If you're attracted to the lithium stocks because lithium is up by 400%, what happens is that the price action has validated the narrative, even while the value has come out of the narrative. So in order to speculate, in order to operate a barbell strategy or a more speculative strategy, you need to be a contrarian. The second thing is that you need to be disciplined. And discipline includes being able to handle volatility. Speculative stocks can increase or decrease in the course of a day by 10% for no reason whatsoever. A big institutional investor needs to come out because he or she has redemption requests. That has nothing to do with the company, has nothing to do with the market. It has everything to do with the fact that somebody who owns 6% of the company has to come off. If you don't have the psychological discipline to weather that volatility and weather market cycles, you can't be a contrarian. And tenacity. Young people in particular, which is ironic because they have more time on earth, seem to have trauma holding stock over a long weekend. While old coots like me, 70 years of age with less time on earth, understand that money is made in 4 or 5 or 6 year durations. To give you color on this, Ben, I did a pretty exhaustive search of speculations that I had made over the course of 45 years speculating that had generated 1,000%, tenfold returns for me. And what I found was that the average 10-bagger required a holding period in excess of 4 years, much more commonly 5 years. It didn't occur in 6 weeks. And more importantly, the average 10-bagger that I enjoyed, some point in time in my holding period, caused me to experience a 50% decline in share price. To illustrate this, I might have bought a stock. Well, let's name one. Silver Standard, 72 cents. The stock went fairly quickly from 72 cents to $6. Pardon me, not to $6, to $2. From $2, it fell all the way back to $1.25. From $1.25, it went up to $3.75. From $3.75, it fell back to $2 or $2.50. From $2.50, it went to $7. You understand the process? This took place over 6 years. Now, ultimately, over 6 years, the stock went from 72 cents to $40. But if I hadn't had the understanding that I would need in the course of the holding to answer a few unanswered questions, if I didn't understand that I needed to be patient through Bob Quartermain affecting the business strategy and buying very low-cost ounces in the ground, if I didn't have the patience to understand that the silver price, in order for the thesis to work out, had to go from $4 an ounce to $15 an ounce, I wouldn't have made the money. And if I hadn't have had the internal faith in the thesis to weather 40 and 50% share price declines 3 or 4 times during the period that I held the stock, I wouldn't have made the money. That, again, is anti-fragile.
I appreciate that answer there, Rick. Very thorough. And, the next mental model I want to go to that I think will add a lot of value to this conversation is called the Lindy effect. And, so my first question is, what is that? And then my other part of the question is, what lessons have you learned from investing in natural resources assets that have persisted over time, which you were just talking about? And how do you evaluate the potential for future persistence when considering new investments?
I guess one of the things that happens with me is that I've done this for so long that I've synthesized some of the processes. I anticipate pain, which is tough for a young person to do. You're trained to avoid pain. I've trained myself to believe that pain and challenges are inevitable, and that the ability to withstand pain, confront pain, is a durable competitive advantage. That part of investing is very different than the rest of your human experience. You are taught as a young person to avoid risk, not court risk. You are taught to avoid pain, to avoid injury, to avoid confrontation. Those are good instincts, but they aren't appropriate to speculation. You need to school yourself to endure pain, to endure turmoil, to endure indecision, not indecision, uncertainty. And you need to learn to court those, because they become durable competitive advantages in communities where you're competing against people who don't exhibit those traits.
I appreciate that answer, Rick. Rick, the next mental model that I want to go to that I think you're going to enjoy answering is talked a lot about by, Warren Buffett or even Charlie Munger, but the circle of competence. So I'm curious to ask you, how do you define and expand your circle of competence as an investor? What strategies do you do to stay within it?
That's a wonderful, if embarrassing, question. And I would answer it to begin with by encouraging all of your listeners in their spare time. They have more spare time than they think, by the way. Turn off the TV. I would encourage them all to read Warren Buffett's letters to shareholders beginning in 1977 till the current. They're at the Berkshire Hathaway website and they're free. What you have is, in effect, a biography or an autobiography from the greatest investor in my memory, for free. And people need to do that. What Buffett wonderfully says is, if he can't understand the outline of a story in 10 minutes, he won't invest. If he has to know so much about the value proposition that he isn't certain of his ability to grasp it, because there are so many opportunities in the world, he doesn't care. He'll pass and wait for an opportunity. Buffett famously says, and I think this is important to the lesson you're asking me to teach, that the investing business is analogous to a baseball game with no called strikes. In other words, if you don't swing and miss, no bad thing has happened. Every pitch that gets by you doesn't count against you. The consequence of that is that to be a good investor, you play baseball by waiting with your bat, which is your money. You wait for the pitcher to get tired, and when there's a nice, slow, fat pitch, you whack it out of the park. You operate within your circle of competence. Unfortunately for me, Mr. Buffett's circle of competence is much wider than mine. As a young man, I enjoyed truly spectacular success in the natural resource business, not understanding that it wasn't a consequence of my competence, but rather a consequence of coming of age during the bull market of the 1970s. The gold price went from $35 an ounce to $850 an ounce. The natural gas price went from 30 cents a thousand to, at least with regards to deep gas, $15 a thousand. The oil price went from $2 to $30, and I thought I was a genius. By the end of that bull market, when it busted, I found out just how smart I was, which isn't to say very. But let's go on. As a consequence of being successful in natural resources, and a consequence before that of being successful in the hospitality business as a young man, I decided that I was a good businessman generally. And I dabbled in businesses as widely diffused as motion picture production finance, real estate, a variety of businesses. And the consequence of that is that I learned just how smart I was, which is to say, not very. What I have learned in 45 years of investing is that there are roughly 3 schools of investing that are suited to my education, my experience, and my psyche. And they are as follows: illiquid deep value, specifically in very bad markets, cash flow positive, mundane companies that are selling at a discount to net working capital, which is to say where their inventory and their cash is worth more than their enterprise value, their market capitalization and their debt. And you're getting the free cash flow for free. I don't need much competence there. I once owned a liturgical candle maker. I don't know anything about making candles. I don't know anything about church. What I do know is that the company had working capital exceeding $20 million, and they had an enterprise value of $12 million, and they were earning $1 million a year. In effect, the earnings were a free bond. So nets are within my circle of competence, within my circle of patience. I can participate in those businesses. Much more commonly, I've spent 45 years coming to understand the natural resources business. It's within my circle of competence. If I don't know somebody in the natural resource business, I can call somebody who knows them. And frankly, if I can't do that within 2 calls, they probably aren't worth knowing. I don't have to waste any time on them. I understand, too, the nature of cyclicality in the resource-based business. I understand enough geology. I understand enough engineering. And I understand the contrarian thesis in the fiber of my soul. So natural resource-based businesses are within my circle of competence. Further, I have the discipline to understand that when an industry is in liquidation, which is to say, when the product price is less than the total cost of production worldwide, rather than being a bad thing, when the industry is in liquidation, it's a good thing. Because if the price doesn't go up, humankind is denied that product. For all of those reasons, I'm a competent natural resource investor, and I'm willing to take more risks in resources, and I'm willing to exhibit more patience because it's within my circle of competence. I can outcompete other investors in natural resources. Similarly, in conventional financial services, I have invested in and operated property casualty insurance companies and reinsurance companies, investment banks, wealth managers, asset managers, conventional banks. I mean, ironically, at age 70, when I ought to be retiring, I'm starting a new bank. I'm comfortable in conventional financial services. I am not comfortable in fintech. There are younger people who are more facile with technology and the applications of technology than I. And I don't try to compete with them. The idea that I would try to compete with say Elon Musk in terms of converting Twitter to an online bank, the probability of my successfully competing against him or even understanding his ability to compete in that sector is nil. My ability to compete with Bank of America and Wells Fargo in starting a new bank, while I understand that I can't compete with them, I also understand that they can't compete with me. So conventional financial services, be it banking, be it investment banking, be it asset management, be it syndication, be it wealth management, well within my circle of competence. I have invested in those businesses for 45 years. But more importantly, I have started and managed businesses in those sectors. Beyond that, I have to be very careful. For me, most of my general market securities portfolio is Berkshire Hathaway. The idea that I can outguess Buffett, the probability that I can outguess Buffett on the broad economy is nil. And I have come to understand that because Buffett's business is structured as a reinsurance business, that he can wrap that investment prowess in a tax wrapper. In other words, he can use policy loss reserves and policy acquisition costs to shelter the operating earnings of See's Candy and Burlington Northern Railroad. So I actually get to employ Warren Buffett as an asset manager in an efficient tax wrapper. Why would I seek to compete with Buffett when he's better than I and I don't have the tax wrapper? Similarly, for the rest of my general securities portfolio, personally, I invest in global ETFs around the dividend aristocrats. which is to say very, very high quality companies that have met or exceeded their dividend expectation every quarter for 30 years. While I could go wrong occasionally with that, the idea that extraordinarily durable businesses, Procter and Gamble, Shearing Plow, companies that generate a ton of free cash, companies that are global dominators that other people can't compete with, at least in the near term, and companies that are polite enough to share some of the benefits of that competence with me by way of dividends. I don't need to exhibit, an awful large circle of competence to invest for the very long term in the finest companies in the world, or to invest in the broad American economy, utilizing Warren Buffett as a stock picker in a structure that's tax advantaged. You follow what I'm saying?
Yeah.
I might get an idea outside of my circle of competence, and I don't care. It's not worth my while to spend the time to compete with people who are better than me when I could spend the time in the oil and gas business, or I could spend the time in the super catastrophe insurance business, or I could spend the time in the wealth management business. The idea that I would waste a lot of time in a competition where I'm not one of the best competitors is something that makes no sense to me anymore.
That is a very thorough answer, Rick. So much to unpack. But the big point that I got is, sticking to what and I've heard you say that a lot, especially on stage at, Jay Martin's conference. You've kind of said a lot when people bring up, let's say, Bitcoin or cryptocurrencies. You say, I don't understand it. And all your
importantly, I don't care.
Yeah.
I have no fear of missing out. I'm delighted if people buy Bitcoin for 20,000 and it goes to 60,000. The fact is, if they make $40,000, they might invest some of it with me. I'm happy for them. The fact that it didn't happen to me is something that's of no consequence to me. It wasn't good. It wasn't bad. It was just amusing.
Absolutely. And I'm also happy that you brought up, fear of missing out, FOMO. And I know Grant Williams, I had him on the other day, and he also spoke about, the fear of screwing up, and how that's important, right? Like a lot of investors sometimes rush decisions that they don't fully understand, right? But Rick, the next mental model that I want to go to, I think it's crucial, and I know you talk about it a lot, and it's called skin in the game. So my question for you is, what is that? And then on top of that, how have you personally aligned your incentives with those of natural resource companies or projects you have invested in? And what, strategies have you used to ensure that management teams and insiders have personal stakes in the success of their investment?
Let's start off by saying not just managers. If I'm taking advice from somebody, that person better follow their own advice. If I'm, which I do now, if I'm entrusting some of my money to an outside manager, that manager better have most of his or her net worth in the same product that I'm investing in. The truth is, and I digress, Ben, but I'm going to digress. One of the things that I started doing 30 years ago was, rather than investing in funds, I started investing in fund management companies. I decided it was simple arithmetic. I could either be part of their fee stream, or I could enjoy their fee stream. And I decided that it was arithmetically better to receive fees than to pay them. So while, as an example, I've been an investor in several of the Sprott products, I'm the largest shareholder of Sprott. Rather than pay Sprott 35 basis points to manage an ETF for me, I would rather own Sprott and be paid a 3% dividend. That's skin in the game. I want my outcomes to be completely aligned with the manager's outcome. Now, the same goes for newsletter writers, people that are third-party purveyors of information. For a while, the largest financial newsletter publisher in the world, Agora, forbade their interviews, their editors from owning the stocks they recommended. That coincided with me no longer subscribing to Agora products. I wanted the person who recommended a stock to me to be deeply involved in the stock. I didn't want he or she to be merely selling information to me. I wanted them to be selling information to me that they had acted on themselves, which proved to me that they thought that the information had value, separate and apart from subscription revenue. But the way you ask the question really goes around management teams and skin in the game. Skin in the game means that they participate in the upside the same way I do, and they participate in the downside the same way too. If a manager's incentive is involved around their salary or bonus, they will take steps to increase their salary and bonus. If their incentive is ownership in the business, they will take steps to increase the returns that accrue to them as owners of the business. Given that they're not paying me salaries, given that I don't have an interest in their bonus scheme, given that I don't have a royalty on their earnings as a human being, the incentive that matters to me is incentive that flows from the same type of exposure that I have. I have a lot of experience with this. I had a manager once say to me many years ago, just telling me all kinds of wonderful things about his company. And when he was telling me these wonderful things about his company, I happened to be able to look at data associated with his share ownership and his insider position. And it turned out that he believed that his company was the greatest thing since sliced bread, but he didn't own any. And I was able to say to him, sir, if this thing is so wonderful, why don't you own any? And he said, oh, well, I have a very large options position. I said, oh, are you trying to sell me some of your options? No, you're trying to make me a shareholder. If making me a shareholder is good for me, why isn't it good for you? There's a public mining company out there right now. I won't name it. There's a public mining company out there right now where the combined management salaries, general administrative expense related to salaries and stuff is about $3.5 million a year. And the combined shareholdings of the managers who enjoy those emoluments, managers and directors, is less than $1 million a year, which is to say that their annual compensation is 3.5 times their exposure to the stock. But it gets worse. This group of managers, employees and directors, have bonuses equal to 5 years of their average compensation if the company's sold. Now, it's easier to sell a company from a lower cost base than from a higher cost base. So these managers, because they don't own any shares, actually have an incentive to see the share price go down. Down. How is it that my benefit is correlated to their benefit? Skin in the game means not just that they have a fair bit of stock, but that they paid a substantial amount for that stock. That if they make a mistake, it will be reflected in their family's lifestyle, the same way it'll be reflected in my family's lifestyle. I have enjoyed spectacular success over time in speculative resource activities alongside Ross Beatty. I've now done 14 companies with Ross Beatty and made money 13 times. In every case, Ross Beatty was a very large shareholder. And in almost every financing in a Ross Beatty company, Ross Beatty participated in the financing. That means he didn't just cruise on his laurels with the cheap stock. He financed at every level. And Ross Beatty didn't sell stock. Ross Beatty didn't trade his own stock. He didn't use the information that he had to my disadvantage. He sold all his stock at the end of the exercise after he'd built the company, the same way I did. That's skin in the game. The consequence of that is that he worked like a slave on those companies. And he didn't just work like a slave. He didn't just work hard. He worked smart. Similarly, I've been invested with the Lindy family through now 3 generations. 3 generations. I've invested with the Lindy family since 1975, since I was a 22-year-old. The hallmark of the Lindy companies is that the Lundins always own 20% or more, so that their efforts reflect on the family fortune. They don't trade the stocks, although sometimes they trade the options. They build the companies and they sell the companies at the very, very, very end of the exercise. I've been involved in Lindy efforts that failed. Those failures have cost me, several $100,000. But they cost the Lundins $8 or $10 million. That's skin in the game.
I really appreciate, Rick, that full answer there, because skin in the game is so key, I think, for any investor, tuning in, because it obviously shows, that commitment, right? Kind of like you said with Ross Beatty, you really gave an example, how he pretty much slaved his time, right? He was dedicated. But he was extremely motivated, and it kind of, we kind of heard that based off of, 13 of your 14 investments with him that have been home runs.
In my educational products, in my boot camps, and in my live conferences, my favorite feature is the Living Legends, where I bring in people who have built multi-billion-dollar companies from scratch. Every one of the Living Legends, every single one of the Living Legends believes in themselves enough that they have owned major proportions of those multi-billion-dollar companies. There wasn't a wage slave in the lot.
No, I appreciate that. And so who are some other, living legends, whether it's, past or even current? Like, are there any future, living legends that are coming?
Certainly Bob Quartermain, one of the living legends. Sean Rosen, a living legend. Rob McEwen, a living legend. Looking at the younger guys, all of a sudden his name escapes me. Nolan Watson, Sandstorm. Started the company. Most of his net worth is involved in the company. Again, he hasn't yet been serially successful, but I look at the team around EMX Royalty as an example of young people. There are a whole group of younger guys. I have less experience with them, frankly, than I do the people who are effectively my age, who I've done business with for 35 or 40 years. But believe me, I'm always scouting for them.
I totally understand, Rick. Awesome. So Rick, as a bonus mental model, what is one that you use that we haven't spoken about to evaluate investment opportunities, and how they helped you navigate uncertainty in the markets?
Common sense, sadly lacking for investors. If you are speculating, understand that the process involves the answering of a series of unanswered questions. In order to do that, you need to apply common sense. Ask the company, what is the most important unanswered question? What you'll find when you ask that question is that 80% of the companies don't have an answer. Common sense means you stop talking to them. You don't waste your time. You throw that idea away. If the value creation mechanism isn't in place, if they are going to create value, it's going to be by accident, and you can't speculate in it. Following on from that, okay, they gave you a reasonable answer. Explain to me how you came upon that answer. That question, pardon me. Was it ground truthed? Was there data that told you that that was the right question? Or is that the question that the market was interested in? Is the question that you're asking yourself a sales tool, or does it actually unlock value? Again, common sense. How do you propose to answer the question? How do you propose to test the thesis? Will the question be answered by the proposal by which you propose to test the thesis? Is this the most efficient way to answer the question? This isn't rocket science. This is common sense. The question may be, we have a surface anomaly. We've pulled a bunch of surface samples. The surface samples were good. We trenched it to see whether the mineralization was transported in loose material or extended to bedrock. And we found that, in fact, the mineralization extended to bedrock. Now we need to put 5 holes into it to test the depth. That's answering an unanswered question. That's a good answer. But without this sort of even superficial due diligence into the value creation mechanism and the application of common sense, you will be diverted in speculation to the 80% of issuers that are either stupid or purely promotional. The final part of, I guess, this common sense is, let's say that the proposal to answer the unanswered question, you ask how much time it's going to take, right? Let's say that you think it's going to take 2 field seasons to mobilize the drill rigs, to drill 5 holes. You're going to want to see the results of the first two holes before you drill the last 3. So you say to the guy, how much is it going to cost to answer these unanswered questions? The answer comes back $5 million, and they can substantiate it. Okay, $5 million, and it's going to take 1.5 years. So it costs you guys $1.5 million a year in G&A to run the company. So to get me the answers to the unanswered questions is going to cost you 5 plus 1.5, $6.5 million. How much money do you have in the treasury? $2 million. Well, common sense says they don't have enough money to answer the unanswered question. Ergo, they're not going to be able to answer it. So you say to the guy, listen, you're short $4.5 million. Where are you going to get the money? How much are you going to have to dilute? Who is going to give you the money specifically? Because if I don't have some confidence that you're going to have $4.5 million to answer the unanswered question, you aren't going to answer the unanswered question. And the value that you've told me you're going to cause to occur isn't going to be caused to occur. This isn't rocket science. This is common sense and a little bit of hard work.
I love that, Rick. I'm happy that you brought up to, that power of, asking that unanswered question, and if they can or cannot answer that kind of gives you your answer. Because I think, there are so many companies out there, and lots of times investors, kind of follow the herd, mentality. And they don't properly actually, meet the CEOs and ask those questions, right? So I really appreciate that. Rick, something that I want to move to is, I'm curious to get your opinion on who you think are the most trusted voices in natural resources. So if there's right now, a millennial or Gen Z or anyone tuning in, where should they go to better educate themselves?
I'm going to give you an answer you're not going to like. The most important expert around your own portfolio is you. So before you worry too much about trusting a third party, you need to invest enough in your own paradigm that you can consume that third party's information well. I, as an example, in exploration, if you're talking about somebody you could subscribe to, I like the work that Brent Cook and Joe Mazumdar do. That's not a cheap letter. I think it's $1,500 a year. I can consume that information because I've spent 45 years understanding how to consume it. And when Joe Mazumdar talks about a stock, the fact that he likes it isn't good enough for me. What it is it puts the investment in a context that I am prepared to understand. So before you worry too much about consigning your financial future to a third party, in other words, before you allow yourself to be lazy, which is really what you're doing when you ask that question, what you need to do is prepare yourself so that you can be an intelligent consumer of information and paradigm from the third parties that you search for. The best third party for an investor, I think, is free, which is to say, read The Intelligent Investor, read Anti-Fragile, read the annual reports from Berkshire Hathaway, because that will make you a better consumer of third-party information. Without preparing yourself to consume and analyze the third-party information, the third-party information itself becomes a crutch. You're buying a stock because Joe Mazumdar likes it, because Brent Cook likes it, because Rick Rule likes it. And those are the wrong reasons. You need to buy a stock because you like it, and because the information that you were introduced to by the third parties resonated with you and was useful to you.
I really appreciate that answer, Rick, because the whole point of this conversation was to create, a conversation to help people become more independent thinkers, right? And to think about these concepts. And last time I had you on my podcast, you talked about some other, great influential books. My next question I want to ask, who is a future guest, someone that you know personally that you think would be a great fit for this show?
You had Grant Williams. One temptation was to say Grant Williams. I don't know if he would do it, but at my conferences, Robert Friedland always outpolls me as the best speaker at my conference. You'll have at my boot camps 3,000 attendees, and many of those attendees are there because they followed me and my way of thinking for 30 years. And when I poll them, they vote Robert Friedland a better speaker than Rick Rule at Rick Rule's own conference. Robert Friedland has been a unique human being in terms of his own self-education. He's a polymath. And he has the communication skills where he can put extraordinarily complex topics into plain English. Now, make no mistake, he is a teacher on a mission. The mission is to make his own stocks go up. So you will not get unbridled information. You will get information in the context that he wants you to hear it. But I would suggest that learning from Robert Friedland about how he learned to learn, and in particular, learning from Robert Friedland, how he consumes information from experts, discarding the gratuitous information that they give that isn't central to what they have to offer, and utilizing the information that is central to what they have to offer and synthesizing that information with information that he got from other sources and using that to make a conclusion. Robert is a truly unique human being. And given the question that you just asked me, if I could pick anybody from my circle of competence that could expand the circle of competence of your listeners, it's probably Robert Friedland.
I really appreciate that answer, Rick. And I just want to add a comment that, he spoke at PDAC this past year, and he really was a remarkable speaker. In fact, a lot of the stuff that he said, really intrigued me, in terms of his special.
He's a better speaker if you interview him. One of the best information products I ever put on in my life was moderating a fireside chat between myself and Robert at Minds and Money in London. And the ability that I had to focus his response and make it more educational, less promotional. By the way, I didn't succeed completely. Made that probably a better presentation from the audience's point of view than Robert Unbridled would have been.
That's awesome, Rick. Well, Rick, I really appreciate that again. And before we go, I want to, bring up, I know it's really exciting. You got 2 conferences that you're involved with that are coming up. One of them is the Electric Battery Metals Virtual Bootcamp. And then the other one is the Rick Rule Symposium on Natural Resource Investing. So do you mind just, talking about those for my listeners?
Yeah, I want to talk about 3 things, if I may. The first is Rule Investment Media, which is a great deal because it's free. We have the Rule Classroom, which will ultimately be a 60-part series about how to invest in natural resources. It's my book. but it's going to be video. It's free. Go to ruralinvestmentmedia.com. While you're there, list your natural resource portfolio, and I personally will evaluate it. I'll grade your portfolio 1 to 10, 1 being best, 10 being worst, and comment on individual issues where I think my comments might have value. Once again, it's a hell of a deal for free. Moving on from there, in about 2 weeks, we're putting on the electric and battery metals boot camp. This is 8.5 hours of programming from the best experts in the world around battery and distributed power. It costs $99. By the way, you will have access to the tapes for 6 months. It is impossible that anybody can get all of the information that we're going to give you in 8 hours in 8 hours. I myself have listened to the tapes from my old uranium boot camp now 6 times, and I knew the information. I put it on. So it isn't just an investment in 8 hours and $99. It's an investment in 6 months to come to understand what is probably the most complex, but the most prospective part of the natural resource business for the next 10 years. If you pay me the $99 and attend the boot camp, if you don't think it's worth $99, email me and I'll give you your $99 back. No questions asked. Beyond that, you mentioned the Natural Resources Investment Symposium in July in Boca Raton, Florida. This is my big event. This is where I bring the big picture thinkers together, but not the big thinkers that you'd see on NBC or CBS. Rather, the Jim Rickards of the world, the Bill Bonners of the world, the Grant Williams of the world, the people who explain the world the way that it really is, rather than the way that the big thinkers would like you to believe it is. Beyond that, we bring the best analysts, the best portfolio managers in the natural resource business to teach you how to construct portfolios around the big picture that you heard about from the gurus. But better than that, we bring you the living legends. We bring you 4 or 5 people who have built multi-billion-dollar natural resource companies from scratch. And they teach you how they built the companies, how the lessons that they learned make you a better investor or a better speculator. But it's better than that. Every exhibitor at the conference isn't merely an advertiser, they're content too. Every exhibitor there will be owned by myself or one of the other senior contributors. There's no guarantee, sadly, that every stock I buy goes up, but there is a guarantee that I know the exhibitors well enough that I've invested my own time and treasure in them. Again, you can either attend this event live, which you should do, or if you're unable to, by live stream. And both the live attendees and the live stream attendees will be able to revisit the material on the conference all the way through the end of 2023. By the way, there will be workshops for the presenters, workshops for the exhibitors, and there will also be the ability to set up one-on-one meetings with the exhibitors so that you can really get into the heart and brains of the investment opportunities that are at the conference. And like every other information product that I've ever sponsored, if you are a live attendee or a live stream attendee and you don't think you got your money's worth, email me. I'll give you your money back. In 30 years of putting on investment information products, I've had to refund less than 0.2% of the tuition fees that I've received. So the chances that you come to this event and don't believe that you got your money's worth are infinitesimal, but the financial risk is mine. Absolute, ironclad, money back guarantee.
Awesome, Rick. Well, thank you for talking about those conferences. I really appreciate what you do for this space, and I know other people tuning in as well. So thank you for organizing those. And Rick, I also want to take this last bit of time, to really thank you for being here. Thank you for being, generous. You're always so generous with your time. I saw that again, backstage, as well as on stage at any time of Jay Martin's conference. So I just want to take this last little bit of time to, show some gratitude and kind of thank you for being you.
Thank you. I had the advantage when I was your age of spectacular mentors who saved me a lot of mistakes. And to the extent that I didn't take the opportunity to pass it forward, I would be degrading the benefit that I got from those mentors. I would be degrading their memory. So I appreciate the opportunity to pass it forward, which I consider to be a solemn duty.